Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Thank you for being here. Today, we are talking about the new legislation that was recently passed in the House and in the Senate called H.R. 1, the One Big Beautiful Bill Act. And it is the landmark legislation from the Trump administration. And it has, of course, some impact on real estate investing. And so, Paul, you have poured through the bill and notes and commentary and have some insight on how this might affect investors. So would love to hear your thoughts on it.
Yeah, great. Thanks, Brandon. Always fun to be here. H.R. 1, or the Big Beautiful Bill, as it's been referred to, does have an impact on commercial real estate investing. And I'm going to try to cover about 7 things. Actually, there are 3 or 4 that I think are really at the core, but we'll mention the others. But before we get started, I want to be sure to remind everybody that I'm not a CPA and I'm not about to give tax advice. And so, if you hear something in what we cover today that's interesting and you want to explore it further, get to the details and make sure it's applied correctly in your situation, you need to talk to your CPA. We're just going to try to give you an idea of the areas that might be worth investigating as a passive investor in commercial real estate. So with that, right, Brandon, we'll jump in. I'm going to go from sort of least impactful to what I think is the most impactful provisions of this bill. And we'll sort of roll over some things pretty quickly. Others will stop and dive in a little bit more. A couple of things that the bill did, it expanded the state and local tax caps. So particularly if you're in a high tax state, it will allow you to deduct more of the cost of state and local taxes that you pay related to your investment real estate. That really doesn't have an impact on, for example, our fund and typically syndicated investments, but more on personal real estate or residential real estate that an investor may own. But that was one provision of the bill. It preserved the mortgage interest deduction, which is, I think, critical and crucial in real estate, both personally for your own home as well as for any investments that you make. Those were a couple of the smaller provisions of the bill that I thought were just worth mentioning. The next thing on the list is opportunity zones. If you're not familiar with them, the 2017 legislation created designated opportunity zones around the country where they offered specific and pretty dramatic incentives to invest in real estate and operating businesses in those areas. I'm not going to try to dive into every detail of it. It's incredibly complex. There are investment opportunities that are built around the opportunity zones. And if you're an opportunity zone investor, what you need to know is that they've improved the incentives and they've extended the life of the opportunity zone concept, as well as added additional opportunity zones where if real estate is located in those zones, you can defer taxes on a sale if you hold it long enough, and ultimately even avoid taxes completely if you hold a property for longer than 10 years. That is in an opportunity zone. So the opportunity zone provisions were enhanced. Next on the list is the 1031 exchange, which is a like-kind exchange provision in the tax code that allows you to sell a property and roll those proceeds into another investment in a similar type of real estate. And the 1031 exchange provisions were protected. There were no changes made to them. And if you're familiar with 1031s, and I know a lot of folks out there use them on a regular basis, and may invest in some 1031-oriented exchange funds, the opportunity to do that and the provisions around it weren't changed in the Big Beautiful Bill. So no new news there, but the good news is there were no changes. What some might view as a negative element of the Big Beautiful Bill related to commercial real estate is that it eliminated almost all of the tax credits related to green energy. So, for example, in the storage industry, it's become more common to put solar panels on the roof of storage buildings. There were tax credits available that had value to the investors, and obviously it created another revenue stream because you could sell that power back into the grid. The tax credit, you could still do the business part of it, but the tax credit for the solar and other green initiatives have been eliminated as part of the Big Beautiful Bill. The next two, and I'll stop and take a breath there, Brandon. Any questions on your part, or anything that I missed or you want to add?
No, that's interesting about the solar panels, though, to think about it, because I wonder how that will affect the market, whether people will continue to add solar panels onto the storage units, because maybe, it could help power the facility and all that kind of stuff. But yeah, I'm just curious how that would work.
Yeah, I think from an economic standpoint, it probably removes most of the motivation.
Gotcha. Okay.
We have not done it. We've looked at it. In fact, we were studying it as we looked at Fund 2 and considered. There were a couple of groups out there that brought concepts to us that looked interesting. Without the tax credits, I'm not sure. From a purely business standpoint, from a philosophical standpoint, there may be lots of good reasons to do it. But from a purely financial standpoint, I think the tax credits were pretty important to that equation. So I wouldn't want to be in the solar panel business right now, I guess is the way I'd put it.
Understood. Okay, good.
The last two things on the list are I think, where the biggest impact is in the Big Beautiful Bill. And the first one is qualified business income deduction. And for many of you out there, particularly if you invest in income-oriented real estate funds, this may be something that you're not familiar with, and I would highly recommend that you talk to your CPA and get familiar, because it's a pretty substantial benefit. The qualified business income deduction was increased in the Big Beautiful Bill from 20% of the qualified business income to 23%. And they also added and refined some safe harbor provisions that make it much easier for a passive investor to take advantage of those deductions. There are some earnings limitations that come into play if you make more than $191,000 a year as a single person, or $383,000 as a couple filing jointly. You can find that your QBI deductions are limited, but there are even some exceptions beyond that around the unadjusted basis in the property, and there are some calculations that can be done. But I think the thing I want to point out, and I didn't do this very well at the beginning, is that the qualified business income deduction allows you. Let's say you're an investor in an income-oriented self-storage fund that's buying existing properties, and you're getting a 6 or 7% cash-on-cash return every year, and reporting. And your pro rata share of that income is being reported on your tax return. On your K-1, which is ultimately impacting your tax return. Just as an example, let's say that you had $10,000 of income reported on your K-1 to you as your pro rata share of income from that investment for a given year. The qualified business income deduction allows you, in this example, to take a $2,300 deduction on your tax return to offset a portion, 23% of that $10,000 of income that you reduced, therefore reducing your ultimate tax bill. And I think most people think the qualified business income deduction only applies to real estate professionals, but that's not the case. It's actually well designed for passive investors who own an interest in an LLC or a limited partnership or a real estate investment trust to take advantage of this deduction. And depending on how much qualified business income you have from rental real estate, it can be meaningful. And I think it's often overlooked by most passive investors. So I would just suggest I've done probably a poor job trying to give you some details. There are some safe harbor requirements that have to be met for a passive investor to take advantage of the deduction. There has to be at least 250 service hours or work hours on the property by somebody. It does not have to be the passive investor. Obviously, they're passive. a property manager, in our case, a sponsor who's also the property manager. You do have to keep separate books and records for each property in order to qualify for the deduction. And then you have to keep written documentation of the hours of service and who performed them on the property each year. In our case, we tick all three of those boxes. So our investors would be qualified to take the qualified business income deduction. And just to be clear, it can't be offset. It's not calculated based on service revenue. It's really only based on rental income generated by real estate. So, but which perfectly applies to commercial real estate because that's what we do. So, but I think it's an overlooked provision in the tax code, and I think probably a lot of CPAs aren't focused on it. So if you have a portfolio of real estate that's generating significant income on an annual basis, I would suggest you talk to your CPA, dive into it, and see if there may not be a benefit in there for you.
Yeah, I was going to say, I don't know tax accounting at all, but that sounds like a really obvious one to bring up with a CPA, especially if they're investors in AAA's funds, because you guys do tick those boxes that can provide that documentation. So it sounds like an obvious choice to bring up. That's awesome.
Yeah, I mean, a $2,300 deduction won't change your life, but it's better than a sharp stick in the eye, right? I mean,
it's worth a phone call, yeah.
And, at the 35% tax bracket, I can't do the math in my head fast enough, but that's $700 or $800 worth of tax savings. And obviously, if you have $100,000 of passive income from real estate, then it becomes even more substantial. Now it's a $23,000 deduction. So, which has a corresponding benefit. The last item on the list in the big, beautiful bill is the one that I think will impact most passive real estate investors more than any of the others, although I think QBI is substantial, and that is the bonus depreciation. In 2017, in President Trump's first term, they created the bonus depreciation where in the first years of that, you could deduct 100% of the depreciable basis. You have to do a cost segregation study. You have to componentize the project in order to identify the amount of depreciation. But you could take 100%. That was phasing out. It was down to 60% in 2024 and would be and is, because that provision still survives, 40% in 2025. However, the big beautiful bill brought bonus depreciation back, 100% depreciation in year one, which substantially improves or impacts cash flow in a positive way and provides potentially passive losses that you can use to offset other passive gains or income. And so it is reinstated at 100% of depreciation in year one. The properties have to be purchased after January 19th of 2025, and they have to be placed in service by January 1st of 2030. There is a special category called qualified production properties. That's basically factories and industrial facilities, and they get an extra year to be placed in service, or they can be placed in service as late as 2031. But they also increase the Section 179 limits, which is the rapid depreciation of certain assets, from $1 million to $2.5 million in terms of the limit of those deductions that you can take. But all in all, the reinstatement of the 100% bonus depreciation in year one is likely to have the biggest impact on real estate investors across the board, because it does allow you, particularly in our case, we happen to sit in a situation because we're developing real estate where the bonus depreciation obviously comes into play and allows us to deduct in self-storage about 60% of the total project cost is generally what would qualify for the bonus depreciation. So in a $10 million project, we're looking at a $6 million depreciation loss or write-off in the first year when the property's placed in service. And that, of course, passes pro rata to all of our investors. As we are in the fund, if you're building multiple properties at one time, and that portfolio is not generating revenue yet because it's early in its maturity, you can get some pretty substantial losses in the early years of a development fund, a growth fund like our fund. So we think that's going to be a very positive thing for our investors. I will remind everybody that depreciation is simply a deferral of taxes. It does not allow you to escape paying taxes forever, because when the property is sold, there's recapture of that depreciation in generally as ordinary income. There's some nuances to that, but it is really only a deferral. But if you could avoid paying the tax on those dollars for 4 or 5 years, there's some value in that, even though you have to ultimately pay the taxes down the road. So,
okay, I may be naive, but I think maybe an example might really help. So let's say I'm an investor and I put in $200,000 into the fund, and let's say it's this $10 million property. $6 million has a depreciation effect. How does that impact me as if you were to kind of calculate my taxes over the couple of years? I mean,
in your example,
might need some help.
In your example, it was a single property fund with a $10 million piece of real estate, and you invested $200,000. So that means essentially you own 2% of that partnership. When they take the $6 million deduction for the bonus depreciation, and let's just to keep things simple, let's say there was no other economic activity. Obviously there would be some small amount of income in the early months and some operating expenses, but let's just ignore them for the moment. So you've got a $6 million deduction, and you own 2% of that partnership. So you would be allocated 2% of that $6 million bonus depreciation loss, which would equate to $120,000. So you invested $200,000, and year one, you get a $120,000 passive loss that you can use to offset passive gains that are created in other investments that you made. And if you don't have any passive gains this year, or if they don't equal $120,000, you can roll that loss forward and use it in future years. So you can bank it and use it at a point in time in the future where you actually have a gain to offset with a loss.
Man, fascinating. Okay, that could be extremely helpful, I could imagine. I mean, obviously, there's a lot of calculations involved in how you do all that work with an accountant, but yeah, it sounds amazing. So you guys would provide the documentation necessary to kind of figure that sort of thing out.
All of that, your pro rata share as it relates to qualified business income that we talked about a minute ago, or as it relates to the ultimate net loss produced by a property or a fund because of this bonus depreciation. All that information is provided to you in your K1, your Form K1 every year that the fund sponsor will issue. And that's what your CPA uses to do the tax returns. And he can get all the information he needs in terms of how much qualified business income did you have, if any, or do you qualify for the deduction, all those things, as well as, okay, what was the net loss on the K1 and how can we apply it in your personal tax return in order to get the highest benefit. So yeah, in that example, you would have received a K1 that showed a $120,000 loss as your pro rata share of the economic performance of that property, and therefore you get to take that $120,000 loss on your personal return.
I'm glad people like you exist to do all this kind of stuff. Okay, so this sounds like a really positive or beneficial bill, in specifically for real estate investors in this case. With that kind of your overall, you feel like this is a good thing specifically for investors?
Yeah, it didn't change any of the fundamentals of real estate, which I think is probably a good thing. The bonus depreciation has been a very valuable tool for people in the real estate industry. And so bringing it back, it was phasing out and almost gone to the point where it didn't have, nearly the impact that it did originally. So I think bringing that back, I think the qualified business income, on the whole, the bill for real estate, commercial real estate is a positive bill, but I don't think it changed the world. I don't think it changed anything fundamental, but it did make some incremental improvements in some aspects of how the tax code impacts invested in commercial real estate.
Yeah, and helpful. Okay. What else? Is there any other kind of tidbits that you found in your research that are useful for investors that they should know about?
I was really focused on trying to extract the major provisions of the bill that people needed to be aware of as they consider investments in commercial real estate. So obviously, the word "big" in the name "Big Beautiful Bill" is no misnomer. I think they had a reading of the bill.
1,000 pages, I think. Is right.
Yeah, I think they had a reading of the bill as part of the process during the vote on the bill, and I think it took 16 hours to read it. So, so there's a lot in there, and there's a lot of aspects that affect lots of different areas, but these are the ones that really impacted commercial real estate. And I just thought it would be timely and hopefully helpful and interesting to have a little chat about them, since the bill was just passed on July 4th. But anyway, thanks, Brandon.
That's right.
Always good to get together. Really appreciate it. And if you have questions about the things we talked about today, like I said at the beginning, please talk to your CPA and get guidance from them. That's the right way to approach this. I just wanted to make sure people were aware of some of the major provisions in the bill that impact real estate.